All right. Get this. And we will be going over the daily time frame today. In here, this is actually a perfect example. I'm going to be doing two examples today, actually. I'm going to be doing two examples today. We'll be covering the daily time frame. This is going to be basically like a liquidity hack, a directional bias hack, an analysis hack for using the daily to enter on the like 15-minute, 5 minute. Your entire analysis should be based off of the premise of the daily drawing to some way of liquidity or another. So obviously, if you zoom out here on the daily on Australian dollars Swiss franc, I'm sure everyone's in here. You got one more. I'm waiting on one more. Okay, I'll slow down a little bit before I get started. Because this is a trade that I was going to take today, or I did take today. Hey, none of that. Jesus Christ. That would be a comical edit out. Colors are fun. Anyways, so I'm gonna get started now. We will be covering the daily time frame, and basically I'm gonna be showing you the trade that I looked at today and that I actually did take. Colors are very fun. Oh my gosh, they're so fun. They're going crazy all day long. She's at that age. So we'll be covering the daily time frame, and we will be covering basically a hack on analysis and gauging liquidity. You're going to pretty much write down these notes and write down some of these will be like notes / rules you're going to be following. Within the trading plan once it's finished, right? So the first thing I noticed here on Australian dollar Swiss franc is that there was an order block that was respected here. This is the last bullish candle before the break. So I'm gonna draw that in real quick. I'm going to the chat box if that makes sense. This is the one that the big impulse move down that pretty much solidified that this was the one that was going to be respected came from. And so that's the daily order block right there. And I think I have a template for that, if I'm not mistaken. Sure do. So that's the daily order block that I saw respected. You can see that I cleared all of that buy side. It's obviously in premium territory relative to the last actual break of structure. If you look over here to the left, it broke structure on this bearish candle right here, this old swing low, right? Don't run the chat box if you can see that. And that's where the continuation came from, and the impulse move came down. That's why that's an important order block, because this order block took liquidity and then had the continuation, right? That's why that's significant. So when you're looking at order blocks on the higher time frames, always pay attention to ones that took liquidity. So this is what major sell side liquidity looks like just on the daily time frame. It'll look like candles, as you can see when liquidity is taken. For example, this candle right here coming up to take this buy side, it's never a bunch of candles. It's just like a single candle or two, and then there's a continuation. Even right here, you can see that this bearish candle at once traded above this bullish candle right here, and the continuation came down. So when you're looking at the daily time frame, you can't judge it like you would the 15-minute, for example, where there's multiple candles and it could be trading above any of these highs, and you have to really filter out. In the daily time frame, it's pretty cut and dry. It likely will trade again, trade over one or two or maybe three candles. You know what I mean? So if there's a direct swing high, the highest wick in this regard, you can see right here in this area of candles, you didn't really have to concentrate on anything else except for the highest swing high price traded above into an imbalance right here, and then there's a continuation. Drop it on the chat box if you can see that imbalance right here, right here. I'm not going to draw it in because it's not part of the explanation, but at the time it traded into that bit imbalance after the structure break, which was the confirmation there, which is the sell side. And with that, I will be going into the lesson, right? So this is like once again a trade that I was looking at today, and I did get into today. I got stopped out, or I manually closed US 30 at minus 0.80% or something like that, because I knew I lost on the trade as soon as I traded above a certain high. I typically do that. If I know I lost on the trade, I'll close it early for the sake of preserving risk. I mean, even if I was wrong, or I could have gotten another entry, that's fine. Follow my trading plan of if it trades above a certain high based on liquidity, I was wrong with the trade. I'm going to cut it at 0.5% or 0.6% if I can. if it doesn't move too fast on it, which it usually doesn't, right? So that's a whole rule of risk management too. Typically with my strategy, with the risk management part of it, which I'll type into the into the trading plan, you're risking 1%, but typically if you have to manually close under the rules, you'll lose 0.5 to 0.8, maybe at max 0.9%. So you keep your losses very low. And when you win, obviously you win 1, 2, 3, 4, 5%, whatever your typical RR is. So price broke down at that point and basically created a fair value gap right here. And I'm gonna draw that in. Yeah, fair value gap. I like to make my daily fair value gaps pretty thick. The lines for them just because it represents the higher time frame, so it has to be thicker than like if I'm doing the same thing for a lower time frame, I either have to change color or differentiate it somehow. So maybe you want it to be 3 thickness for the daily time frame, and then the thinnest or a different color for the 15-minute time frame imbalances if this is how you're doing it. Otherwise, you can use the zones too. You don't have to use these. It just depends on how minimalist you want to be, basically. I like to be pretty minimalist. The most I'll do is I use a small zone like this. I'm looking at an imbalance. I use a small zone like that at most, but it has to be a color that reflects so that I can actually see the candles because that's what matters. You got a day imbalance, and you have the previous days, and we're gonna zoom into this a little bit. You have the previous day's candle right here. Drop one in the chat box if you can see this bullish candle, which was the previous day's candle. I'll mark that up real quick. We're going to use that for, that's perfect. Dope. So you guys see that previous day's candle, and this is where the hat comes in. This is where your mind's going to get blown pretty hard from that green. So this represents, you can do it this way, or you can just have it, neutral colors. I like to put the high of the previous day's candle up to the wick, not the body, the wick, and then the low of the previous day's candle, right? This is an intraday hack, right? Typically, most people would try to put their targets for the intraday targets at major swing lows right here, and maybe even right here, and maybe even right here. So the problem with that is that it's not very realistic that you're gonna get the daily to come from all the way up here to all the way down here in a single day. So whatever target you end up trying to do, right? So if you're like, I'm gonna target this daily sell side, whatever target you end up trying to do, you're going to not end up, you're not gonna end up reaching that target, right? Drop it in the chat box if that makes sense. It takes multiple days of big candles like these, maybe even up to a week, in order to have this low cleared. Once you have the proper confirmations, it takes days, sometimes up to a week, in order for that low to be cleared. So what you want to do is you want to mark up the within the range that you're working in, right? So I have context. This is the area that I'm working in, right? I'm working within this imbalance. And then at the time right here on February 2nd, which was yesterday, and which would have been an opportunity to get into this intraday, we had February 2nd candle, 2023, and then February 1st, 2023, marking up the previous day's high, which is February 1st, 2023, and the previous day's low. You can see that this candle actually used, I'm going to fix that because I'm OCD, this candle actually used the high, and I'll get to that in a second. This candle actually used, the next day's candle actually used the previous day's candle as liquidity and took buy side liquidity. Drop one in the chat box if you can get that, if you see that right there. And then what happened after that? Price ended up selling off. And also at the same time that took that high out of the previous day's candle, it filled the imbalance and had the continuation. So you would have been basing this trade right here off of the premise that you had a reaction to an order block, an impulse move down from that order block. Relative to this impulse move, price was in premium territory. Let me show you real quick. Here to here, price was above the 0.50, which would be this red line, to premium territory. This was the only order block on the daily time frame in premium territory that was chosen in order to go from, right? Drop one in the chat box if you see that as well. So that's where the context for this high probability trade is going to be, right? Fundamentally, Switzerland's going to be doing way better than Australia. Australia just had some bad economic reports come out. If I remember right, it was last week for their country. So Switzerland is a pretty resilient economy. Even when the world's in shambles, Switzerland economy is always strong. So that's why Australian dollars is trying to sell, right? From a fundamental point of view. It took the liquidity previous day's high, which is top of this candle, the wick, and then this would have been entered a target, which would have been a previous day's candle's low. As you can see, it stabbed right into there. What would that be? That'd be sell side liquidity right there. Drop a one in the chat box if you can get that. And that's buy side liquidity right there. And it took that high. So you're gonna write down in your notes that there is a ton of liquidity, right? Whatever day you're in, look at the previous day's candles high, previous day's candles low, mark those up as something, your markups, and that's I would just say this is extremely major buy side, and this is extremely major sell side because you're looking at this from a daily point of view. So when liquidity is taken on the daily, just know that this is how it behaves, right? If you're in the middle of an actual move down, as you can see here in the daily, and there's an imbalance that needs to be filled between this candle's low and this candle's high right here, I'm gonna mark up. I'm gonna wait till the next day because I was like, okay, well, an impulse move happened down from this order block, and an imbalance has been created. Got that. I'm going to the draw on liquidity is obviously these big major lows right here relative to the context that we have that we're in discount or premium territory, and we had the reaction off the order block plus impulse move that created the fair value gap. Now you mark up the previous days high and low because this is a part of this candle right here is a part of the fair value gap. So I'm gonna wait for the next day's candle to trade above into the fair value gap, taking major buy side. That's trillions of dollars of orders right there on the daily time frame. Because this lets you know that the institutions, they don't trade on the hourly, they trade on the monthly, weekly, daily, but mainly the monthly. They basically set their trades for the year and do extremely long-term trading, 9 times out of 10. So after that, we're gonna go down to the 1 hour real quick to see how that reflects. So this is the same markup. This is the same daily high. This is the same daily low of that same candle. This is how it reflects down in the 1 hour. Drop it in the chat box if you can see what happened here in the 1 hour relative to your markups on the daily of the previous day's highs and lows. Also relative to that, and this is the same daily fair value gap right here. So all you're doing is marking it up on the daily and transposing it down to the 1 hour in this case. Price came up, took the buy side. If you remember, this candle up, this leg up right here. That was the buy side take. This is how it transposed on the hourly into the daily fair value gap. You don't need to worry about anything else over here. Nothing. You're only focused on your higher time frame objective, which was the daily fair value gap to be filled. What happened after that? You traded above the highs, of course, right? All of the highs. And you have this nice thick line right here, so you can't miss it. Boom. Price broke down, right, on the hourly. Power of 3. You got strong high right here. Liquidity broke down. Intermediate term high. Intermediate term high right here as well. And this wick. Drop one in the chat box if you see that. So at that point, right, what do? Is there a fair value gap on your H1 time frame? Yep. So we can draw that in real quick. Little imbalance right here. Nothing too crazy. It also took sell side, major sell side right here. Drop it in the chat box if you can see that. We're gonna mark this up as we go. Just marking up things that are very obvious. That's a stiff signal that the banks are doing what? The algo is doing what? Going short. I like to have it pulling all the way through because it shows that price is slicing through that low right there. Kind of like a visual thing. So what I'm doing at this point, right? The point of this candle right here, after all of that, with that higher time frame context, I'm waiting for price to come up and fill this 1H imbalance, of course, right? I'm not worried about whether it's coming into the bearish engulfing. I'm worried about this imbalance to be filled. This is my area to trade in. Once this imbalance is filled, right, then you can start to look to drop down to the 15-minute time frame. Boom. There's a 15-minute time frame. This is that same area on a 15-minute time frame. Same area. What happened? You had a see, you had a displacement higher right here, traded above this highs right here. Boom. You got they failed to break that high. Came down. Eventually, you have a displacement lower. Is there a fair value gap or what in there? Let's see. You had an order block right here, pretty obvious one on the 15-minute. I would have drawn that in because it did take liquidity. If you look and see, this is the leg that took liquidity. And if you drew your Fibonacci here relative to premium discount, the big impulse move that took the sell side, so where's the order block that's in discount territory on the 15-minute? It could be this one. So that's one I would choose personally. So if you ever wanted to know how you pick your order blocks for shorts and longs, pretty easy hack. Eventually you get to the point where you kind of can't unsee it. You automatically gravitate to the order blocks that are highest up in the impulse move down into liquidity. So yeah, a 15-minute order block that was respected. They did take some buy side. Obviously, if they just took sell side, you're fully expecting them to take buy side after that because price moves from what? How does price move? After it takes sell side, what's going to take next? Drop it in the chat. What's it going to take next after that? Every single time, right? So if I see it takes a major sell side right here, let's just say for example, major sell side right here on the 15-minute time frame, and I'm like, okay, I see that happening. Where's the next amount of major buy sides that I can actually find, right? From this candle right here. It's a high right here. I know that's going to be a taken out at least because that's the nearest high. From this candle right here, from this candle right here, you saw this impulse move happen. Where's the next high? Swing high. It's right here. You know that's going to be taken out. Very likely anything near it's going to be taken out too. So the only other order block that could be, right, relative to how price moves and liquidity would be the one right here. In this case, this has more body than wick. So you highlight the body, aggressive entry, sniper entry, price ends up selling off. And then what does it do? It takes out the actual low right here and even exceeds it. This is that same daily low. So let's just say you ended up getting an entry after the mitigation, which there's nothing wrong with that. There's nothing wrong with waiting for the reaction first. Actually encourage it until you get more confident, waiting for the actual genuine reaction first, and maybe a couple of candles. Maybe wait for a reaction and the order block close again. And then you can put your stop loss just behind right here if you wanted to. That'd be a smart stop loss because you're gauging your stop loss based on liquidity. You know that they likely don't have a reason to go back up there. So that's an easy 1 to 3, easy 1 to 4. This is by 11:15 in the morning. Could have had just about a 1 to 4 by noon. Yeah, by about noon, your TP would have been smashed that day. And that's using the daily high and low of the previous day's candle, right? Why, in what context can you use this? If you actually have a move down or an institutional footprint on a daily, you have to wait for the setup to set up, but that's going to be how you're going to use this. Let's look at Great British Pound New Zealand dollar, I believe it was. Real quick. Here it is. Yep. Great British Pound New Zealand dollar. It's probably what I'm going to look at next week. I haven't looked at whether there's news next week, but I did notice that there was a daily oil block that was respected pretty nicely. Price came down, broke structure right here, took major sell side, came up, respected this order block, and then broke down again. And then I drew on this order block as well because it just recently took liquidity again. So I was like, this is the area that I'm working in. I oftentimes will go up and see what's already happened and follow liquidity and what order blocks have been respected in order to zone in on the area that is current relative to like liquidity and things like that. So now I know this is the area that I'm working in. In this case, this wick on this daily candle, there's more wick than there was body. So I decided to draw in the body. Same thing, right? This is the trade that I'll be doing next week. Daily high of the previous day. Because this is relative to an order block. So this is a bit different. Let's say 3 times. And then daily low. The daily low's already been stabbed at, but that's okay. Obviously, if various primary $1 million are sell, they're gonna have to push below these lows too. Plus, there's a daily sell stops right here on this first kind of like swing low, this wick right here. If you can see that they have not stabbed at quite yet, and then even lower one down here for future reference if this continues to be bearish in the future. So you have that, and you have the swing low right here, which has already been stabbed at, but that's, like I said, that's fine. It doesn't have to be a fresh swing low. That's just more context, obviously. That's going to come down there. It's going to have to keep pushing down in order to take the daily sell stops on that major swing low. Drop one on the chat box if you get that. And I can zoom out a little bit so you can see like the structure of everything. That low right there, we're at that low right there. So I like to have that marked up on my daily time frame as well, so I can have a higher time frame reference for why am I getting into this trade on the 15-minute or the hourly or the 4 hour or whatever the case may be. So same thing, it traded above the previous day's swing high with the buy side liquidity. Unfortunately, there was not enough time in the day for this to set up to actually finish itself. I did notice a H1 imbalance right here. An H1 imbalance right here, but I was going to work within this daily zone essentially. But there is a possibility that price could come deeper into premium territory within this area as well. So basically, if this zone gets validated all the way up to the upside, I know that likely this leg right here is going to be what's going to be what they'll be working with. But I am anticipating, based on the fact that it recently traded above this daily high, the daily high of the previous day's candle, that I would be selling from this order block right here, considering that it recently hit liquidity. Drop one in the chat box if you get that. So I'm using that same method to do the same thing. You know, I'm back on the hourly, and then once I have the hourly, I'll check out to see if there's an hourly order block that's also respected inside of that daily fair value gap or daily order block that I'm looking at. So this is the same daily order block, just transposed down to a lower time frame, which is the hourly. It's the same daily high of that previous day's candle and the same daily low. So you can target this low right here for an intraday kind of push, and that is not unreasonable to be able to get at least the majority of this move in one day. Because if you trade overnight, for example, you should be able to catch this in 7 hours, 7 candles. The hourly candles sometimes are very large, depending on volatility. So I did notice that, and I zoomed into this as well. And on the 15-minute, there was an order block. The order block did somewhat get respected on the 15-minute relative to the hourly. So this is Tsunami inside of the hourly fair value gap, and I noticed the 15-minute order block deeper in premium territory. So I'm looking specifically to where structure is broken, which is right here, and I'm looking in discount territory. And obviously, it's been buying up back into premium territory. It's been buying back up into premium territory for quite some time. So this is that same, once again, daily high right here of the previous day's candle, and you can use that as a hack to actually just easier make your life easier basically relative to like the daily move has to be there as you've seen, but once the daily move's there and you have some context, that's what's going to happen every time. So drop one in the chat box if that makes sense to you. And it's the same thing for longs. Obviously, you would be marking up the previous day's high and low and expecting it to trade to below the low of the previous day's candle, and then have a continuation from there. So I know that this impulse leg right here, from basically here all the way down, is one big impulse leg. So this is the leg that I'm working within. This is the trading range that I'm working within. Drop one in the chat box if you remember that lesson. Because what happened here, major sell side was taken. You guys have to be more quiet. Major sell side was taken right here. And that was the last major sell side take. So now I know that I'm working within this range. And price is coming back up into a premium. This order block here. I don't anticipate it coming back up here, but if it does, I know for a fact it's not going to come any higher than this strong high right here. Because this is where this is where the leg started. That took liquidity also. But that's already been respected and continued from. So like I said, I don't anticipate it coming all the way back up here. I anticipate staying within this daily order block that I drew in earlier. So long story short, you look for confirmations like a bearish liquidity shift, displacement higher and lower, things like that on your time frames. And that's what kind of filters in, because the price will let you know when it's actually ready to go down. You'll know when the actual entry time frames are going to be, ready, because you'll have displacement higher and then displacement lower. Until it's ready, you won't have that. You won't have that happen at all. So displacement higher, displacement lower, I'd be looking for still on my entry time frame. And then within that, I'm looking on a 5 minute, 4 minute, 3 minute, 2 minute, 1 minute. Is there an imbalance anywhere within that impulse, like down where the displacement happened? Yes. Okay. Let's focus on that area. Whether it be on the 5 minute, the 3 minute, the 1 minute, I'm going to use that area to enter on, let's just say the 15 minute. Or I might use a 15-minute order block to after the displacement to enter on a 5 minute time frame. You know what I mean? So you can use this in many ways. You might use that 15-minute order block and then draw in a 5 minute fair value gap that happened in context with that in order to enter on the 1 minute. And you can use the higher time frames, the 15-minute as a higher time frame to enter on the 1 minute. And it's no different. The differences between the 15-minute and the 1 minute, nothing. Liquidity moves the same. You just have to wait on confirmation. Just like anything else, these candles don't look any different than these candles right here. It's all the same. They just break down a little bit differently. But a liquidity take is still a liquidity take, and a order block is still an order block. The same principles apply. I would encourage you, if you're an intraday trader, to experiment on the 1 minute, maybe on the demo for a while, applying the same concepts, waiting for the same confirmations. If it suits you, the 1 minute might be a good time frame to experiment on and kind of have in your arsenal. Something that I'm personally working on, I can enter all the way down to the 5 minute, but as high as the 4 hour. And I prefer to nowadays I prefer to be on the 15 minute. But like I said, I encourage you to experiment and using like 15-minute order blocks with higher time frame context in the daily and hourly, you know what I mean, with liquidity and everything to enter in 1 minute. Or if you've never done it, try to turn on a 5 minute from a 15-minute order block with a higher time frame context. You can see how this kind of played out from the daily down in terms of actual institutional footprints and how liquidity was lined up. Drop one in the chat box if you get that. So you're going from the daily time frame to the hourly time frame, down to the 15-minute time frame, and you're using this daily zone as a zone. Like you're not working in any other zone. Your area of interest is right here in this blue overall, because the entire premise of your trade should be based off of the daily and where that's going. So I always look for this. I always look for the setup when I'm trading intraday of previous days candles high, previous days candles low, major buy side, major sell side. It's kind of how the daily takes liquidity and has continuations. So after an imbalance is filled on the daily, right, and you have a positive candle, like let's just say you have a bearish candle after an imbalance fill, you wouldn't expect and you shouldn't expect any daily candle to trade above, or let's just say an order block mitigation as well. Like this right here is an order block right here, right? And it traded above the previous day's candles high. And I fully expect a continuation from here in the coming week, right? So if that happens, I know for a fact after this candle's already closed that there should not be, with I would say a 98% certainty, any other daily candle trading above this wick right here. Drop one in the chat box if you can get that. After the previous day's candle traded above for longs or for shorts, and the previous day's candle is low, such as this, was traded below for longs, you should not expect any daily candle to trade or gravitate above that at all. It should be the next daily candle. The next daily candle should be a bearish actually. There should be very bearish candles. And that gives you context onto when do I actually wait and look for a setup when this happens right here. When the daily sets up so that it is taking the previous day's high or low, depending on your bias, as liquidity in order to post a continuation into an institutional footprint such as an order block, and you expect a continuation. So now I don't expect the next candles to be bullish at all. I expect the next candles to be bearish and very much so gravitate pretty hard towards this low right here and this daily sell stop over here. And then next after that, perhaps a retracement into another footprint in order to chase these sell stops down here. If fundamentals continue to be bearish, because obviously the Great British Pound is doing pretty terrible right now, especially in comparison to the New Zealand dollar. So that's a way to read that. That's pretty much how you read price action on the daily, right? I'm marking up these order blocks and I'm showing you hacks on how to. And obviously, if I'm looking to do intraday, I'm going to use the daily low of the previous day's candle as my potential target, right? It's going to be like my max target right there that I want. That's what I would be shooting for. But like I said, you don't always get that, but it's very common for previous day's high to be taken out and then it trade below the previous day low as well and take that as liquidity. Because after buy side, what happens? They chase sell side, obviously. So previous day's high, and then they're going to chase the previous day low. So you might have previous day high being taken out, and then the next day, let's just say this was not stabbed at already, right? The next day, you might have a very, very strong bearish candle all the way down, like a really full one, just stab down at the flow. That's almost taking out these sell stops. Imagine if the daily pushed all the way down and it took these sell stops as well right here, and your intraday target was here. You could have done a nice risk to reward ratio with 4 or 6 hours of price action. Let's just say you got into it at overnight at 2 or 3 o'clock in the morning or whatever time, right? And you held it. You're like, I'm gonna hold this until 2 p.m. latest. At the very latest, I'm gonna hold this until 2 p.m. or that 2 p.m. push. And you have your reasonable stop loss according to liquidity and everything. And you targeted that previous day as low. There's 9% right there. In one day. Drop in the chat box if that is insane to you. It's very common. Previous day's high gets taken out, previous day's low. Same thing for buyers. If the previous day's low gets taken out, oftentimes there's an interject run up to take out the previous day's highs too, because that's A, going in the same direction as your bias and where price is going, and B, after it takes out sell side, it's going to take out buy side and vice versa. That's the previous day's highs or lower the high. And that's what you're going to use as an intraday target. This is not unreasonable. That's right here. If you reflect that 1 to 9 ratio, right? That's if you reflect that 1 to 9 ratio in the daily, what's that one daily candle right there? That's a short travel for the daily. Yeah, it's very easy to understand. I love it. But look at this. You have your stop loss on the 15-minute you've entered, right? And you expect the next candle to be bearish. You watch out for that to happen. Once it's bearish and you know it, and it doesn't trade above that high, the previous day's high, you don't expect it to once again because the last thing that happened was a buy side take on the daily. This is not unreasonable. Look at this. Look how fat this one daily candle was right here, right? This is one daily candle. This is like not even a few hours into a fresh daily candle once you know it's bearish. Once it comes down here and takes out this low, which obviously can't happen in one day. Look at these candles, these bearish candles. Usually something like this right here, but like place that here. Boom, it was 9%, but you did that on a 15-minute based on the premise that this one daily candle or the next several daily candles was going to be bearish. Drop one in the chat box if you get that. We just took out buy side, just mitigates order block. So order block responsible for the latest major sell side. So this would be technically a premium territory on the daily. Look at that. Premium territory on the daily. So you're relying on one candle, like something like this even, because eventually it was way down here at one point. It's not reasonable. Your stop loss, right, on the 15-minute is based on and should be behind the high of that daily wick, right? Once it trades above the previous day's high for shorts or the previous day's low, longs, your stop loss should be somewhere above that because once again, if you don't expect that to trade above, then obviously your stop loss is more high quality if it's behind the candle's high, which would be this wick right here, that took the liquidity before it went down. Drop one in the chat box if you get that. there's a high probability. There's a very high probability that stop loss is not going to get touched at all, not even close. In the area that you enter in, you're likely going to have a sniper entry, and now you have no drawdown, and you're relying on one daily candle, which can happen in just a few hours. It'd be a big momentum spike that just bloop, and then now you're now you've got 9% in one day on a super volatile move, and you're relying on the the moment when banks actually push the daily down in the bearish move. This is how you catch that. You don't have to catch the high perfectly. Obviously, you're gonna have to wait for some confirmations and things like that when you drop down to your entry time frame, but you're basing that on the premise that you recently took some major daily buy side. This is how I catch very big moves, and I really don't have to trade that much during the week, to be honest. If I really don't want to, because I can catch one move for 11%. If you can tweak your risk to reward to be maybe a little bit less, 11 to 1, still behind the daily high. It checks out. And as you get better at this, you'll have smaller stop losses because you're basing your stop loss based on previous days. Um, after the previous day's highs was taken out, if there was an imbalance or came into an order block, right, that recently broke structure or took major sell side discount a premium territory, my bad. You're going to have your stop loss based on that. Anything behind that is safe. You can have a 17 pip stop loss and have a 12 to 1 ratio if you wanted to. And you're entire this on the daily. Maybe that's something you should test out. So when I'm doing my stop loss, I'm doing that based on the daily. Once this candle closes, I'm going to try to get in somewhere within the high of this candle, right? Somewhere within this high range of this candle. I'm going to try to get in, but on the 15 minutes. Obviously, as it starts to turn bearish and go down, it'll reflect really well on the 15 minute. You'll be able to enter. I'm entering somewhere up here. You have the H1 for reference as well for that. Looking at order blocks inside of this daily order block. Looking at H1 for an order block in premium territory relative to the last major sell side take, which was right here. Drop on the chat box, you can see that real quick on the daily. So I know that from here to here on the hourly, my bad, that this is going to be my range. And likely, they'll either come fill this imbalance I drew in or come to this bullish order block right here. But I don't anticipate that. And then you use that same area to drop down to the 15 minute and use the same logic. That structure break. So now you're inside of the daily and you do your H1 footprint, which is inside of the daily. And you get on your 15 minute, and now you're inside of the daily, which is inside of the hourly, which is inside of the 15 minute. And then now you're using market structure. Now you're using major market structure to and premium territory and discount territory to kind of filter yourself high quality trades. And you can wait for additional confirmations. You can wait for another liquidity take right here. If you want to wait for an additional major liquidity take, that's fine too. After that major liquidity take, that's your range that you're working in. When the price comes back up into a premium, you have an opportunity to enter again if you wanted to. So drop one in the chat box if that makes sense. If you're not sure, demand more price action, demand more candles, demand more sell side liquidity takes or buy side liquidity takes that support your bias, and then get in and execute when you can. Nothing wrong with that. Does anybody have any questions so far? That's pretty much it for this lesson. It was basically a lesson in the daily. I just had to show you how that worked. Perfect. I will. Your homework is going to be a markup set of stuff happened on the daily time frame relative to what you saw kind of happen here. As you can see, you can use the order block. Doesn't really matter what it is, something bullish and bearish. And mark up the daily high, daily low, and you can see in markup where it took the liquidity and it had a continuation from. Or if you're looking at this for like a setup, a setup that you expect to happen based on what you just learned today. One of the two. It doesn't really matter. I'll see you guys later.